All right, folks, and welcome to our stock analysis on Teladoc. And we're going to apply our simple three-step approach of stock analysis. Number one is understanding the situation overview of the company by performing due diligence. Step number two is applying our technical skills to determine if the stock is overvalued and undervalued. And step number three, coming up with our own investment thesis recommendation on whether or not we should buy or sell the stock. And more importantly, what is a reasonable price target based on our valuation that we apply. If you're new to our lecture, don't forget to subscribe to our YouTube channel, turn on the notification so that you can be one of the first to receive an alert once we upload lectures like this one. So with that being said, let's dive into the content and focus on what we have prepared for you. Just a quick overview on how do you perform due diligence in a stock. Because again, it can be very intimidating and complex. There's so much information out there. There's so much financial data. But our job is to simplify something that can be intimidating. So the first step, as I've mentioned previously, is situation overview. With your situation overview, what you're really doing is understanding what is happening with the company. You may look at the stock price. You may go to the company website and read their press releases. You may want to pay close attention to the most recent quarterly earnings to see if revenue increase or decrease. And of course, take a closer look at the company's 10K or 10Q for their financial performance. You could look at the income statement, the balance sheet, and the cash flow statement to really assess or understand the financial health of the company. That's really the first part of assessing the situation of the business. Then step number two, as I'm displaying here on the screen, is applying technical skills. And by applying technical skills, I'm referring to understanding valuation metrics or methodologies that is appropriate for that company. We might talk about discounted cash flow analysis, comparable company analysis, precedent transactions, LBO, merger consequence analysis, so that we can perform our own valuation just like other professionals do. And this will get us closer to determine is the stock expensive or not expensive or cheap. And it can turn out to be a good investment opportunity for us. And then finally, step number three is formulating our own investment thesis and arriving to our own conclusion by simply looking at the value proposition, the brand, the logistics, how they operate their business, and then ultimately use all of this information to just become a better analyst or a better investor. So this three-part process of coming up with or formulating your own stock analysis really compresses everything that you need to do, and it becomes very simple. So hopefully you can internalize this, and then after the end of this workshop, you can go ahead and apply it to your own company. So let's get to it. Okay, so in terms of Teladoc, the first thing to look at is the overall performance year to date on the stock. And it's very clear, as you're seeing right here on our chart. Okay, let me go back up here. And actually, we should improve this. At one point, year to date, they were up 154%, as you can see here. But so far, the stock has declined because of sector rotation, profit taking on Teladoc. So far since June 6th, they're up 89%. But what's important is to understand is how has they outperformed the overall market? The NASDAQ is up 12%. The S&P 500 is basically flat. It's not even up 1%. That's 20 basis points, less than 1%. The Dow Jones Industrial Average is 4%. And also during the entire coronavirus market sell-off, the stock actually increased by approximately 50%. And this is quite interesting because the current consumer behavior, the dynamics and the environment of the economy was favorable to Teladoc, especially when people were being diagnosed, they were being spread, the coronavirus was being spread and more people were getting really the virus. So some of them couldn't even go to a hospital. So another method or an alternative for them to get diagnosed or speak to a doctor was through Teladoc. Their mobile application allowed them to speak to one of their nurses or assistants just in this format, really, just using their video conference format, and they can diagnose the symptoms. And then they can also put them in touch with one of their doctors, and the doctors can recommend a prescription drug or get them to another physician in person. So this is really helping from a technology side, one of the major problems of our healthcare system in the US, which number one, it's very expensive, and number two, is not easily accessible to everyone. So, and you also might need something that is accessible to you 24/7. So if you have the application on your mobile phone, you could easily log in there, type your symptoms, and you can easily talk to one of their assistants to diagnose you and perhaps give you the care that you need. So this is really addressing a problem in our healthcare system. And the market has very well rewarded the company. Let me pull up my pen over here. You can see that year to date, in terms of equity value, the company has increased by $5.5 billion. That is capital flowing from all the sectors of the economy into this particular stock because the business model has a big potential to the upside. Longer term growth, provided that mainstream and other US citizens adopt this new technology and believe the value that it provides. Okay? So, with that being said, let's move on and really understand or dive a little bit deeper on the company by performing a company profile analysis. So what you're seeing here on this slide is traditionally what you'll find in a pitch book. Investment bankers will put together company profile slide like this, and they'll showcase it to a client that might look into acquiring another business. So if you want to do due diligence on a company, I think you should put a slide like this together to really give you a deeper understanding of what the business does. So if we examine this profile slide a little bit more carefully, you can see that Teladoc basically provides virtual healthcare services on a business-to-business basis in the United States and internationally. It covers various clinical conditions, including non-critical, episodic care, chronic, and complicated cases like cancer. This is interesting. Covering cancer. Okay. Congestive heart failure, as well as offers telehealth solution, expert medical service, behavioral health solutions. Okay. And what's important with this, and what's new and revolutionary, is the adaptation of technology and video conferencing. They have their own mobile web application. You can see that right here. And the fact that they have their own mobile application, how many mobile phones are there in the US and globally? That gives you an idea of how big the potential market is. And also you may even look at patients and the amount of people living in the US, which is around 330 million Americans, if I'm not mistaken with that number. So it's a big market potential in the US, but even greater outside of the US internationally when you really see what the potential can be on this business. So this is more on their business model, the product and service that they're creating. But if we look at the financial overview of the business from an equity standpoint, $12 billion market cap. From an enterprise value perspective, where you're taking into account debt and cash, is $12 billion. Now, it's something also important to highlight here is how they perform in the most recent quarter. In the most recent quarter, you can see that revenue went from 128 from the previous year to 180. This is about a 40% increase in revenue, but net income, they reported a loss. So the company right now is losing money because they're spending on the infrastructure, on advertising, general administrative expense to continue to grow the top line. And this is normal when it comes to high growth companies, that in the earlier years, they're burning through a lot of cash, they're losing money to increase their market share. And once they become the dominant player, then they can focus on lowering their expenses and taking the company to a profitable point where now they generate free cash flow, their net income is positive, and there you can see the expansion of margins and the profitability. So they're losing money at the moment. But once we see the estimates from Wall Street analysts, you're going to get to see that in 2 years, the street is expecting them to be profitable. And of course, if they expand margins and become profitable, that means margin will increase and also multiples will increase as well, perhaps yielding or demanding a higher stock price. How high can the stock price go? That is something that we're going to look at in the second part of this presentation. So this is just something that I wanted to showcase in terms of what a typical company profile slide looks like that can help you understand a business from the financial side and also their product and services. So let's move on to the next slide. Let's clear this drawings. Here we go. So when we're looking at the most recent quarterly performance, it really just tells us what's happening on the ground, how consumer behavior is changing, and how it has also benefited the company given the current economic environment with the whole coronavirus, the stay-at-home mandate from the government, and business having to adjust to a new normal that can perhaps leave a legacy where people are just going to stay working at home. And employers, if they need to treat some of their employees because they're sick, again, this could be an alternative method of delivering healthcare services. So here's something very important to note on this slide from their first quarter performance. They obviously beat the top line, right? You can see that the street was expecting 178 million, but they reported 180 million. So definitely beat on the top line. On the bottom line, the losses from a earnings per share standpoint was a little bit higher than expected, 4 cents. The street was expecting 36 cents. They came in at minus 40 cents. And again, it's expected, given that the company is spending heavily on their infrastructure to increase their membership base and just become the main dominant player. So they're burning through cash as expected as they continue to expand. But here's something important that the chief executive officer of the company said, basically the CEO. Here's what has really been happening and why they are growing at a pretty rapid pace. As our client and customers have turned to us during these unprecedented times, our proven ability to meet their needs has elevated our global leadership. So elevated our global leadership role and accelerated our impact on the healthcare system. So the pandemic is essentially the catalyst that has really helped their business improve and turn a lot of perhaps the free members into paid members. And the number of visits, the number of new patients that were utilizing their service also increased because of the pandemic. So it has definitely improved their business. Now the question is this going to continue? Is this going to go mainstream? Is it going to go viral? And is this going to be a better alternative and cheaper way of delivering healthcare to millions of US citizens and also millions of individuals on a global basis? And if that's the case, then of course, what is the potential earnings power of this business in that scenario where they are delivering services to hundreds of millions, if not billions of people in the world? I mean, the world population extends, as last I checked, was 7.5 billion. And healthcare cost is very expensive. And in a lot of cases, a lot of those individuals don't have access to it. So can Teladoc be that alternative to give the rest of the world population access to healthcare, talk to a physician over video conferencing and get the right medical health, the right drug and medicine that they need, just utilizing technology? I mean, it's a beautiful thing that can definitely improve and save a lot of lives. So you have to pay attention to that and see if it has more momentum to continue. So in the next slide, we go a little bit more in depth in reviewing the first quarter results. And you can see how many people they actually service in that first quarter. So in the first quarter of 2020 alone, Teladoc Health delivered 2 million medical visits to people around the world. 2 million. This is only in the first quarter. So if you were to think about this, the first quarter was 2 million people. There's 4 quarters out there. So can they potentially deliver medical services just again through video conferencing to 8 million, right? You take 2, multiply by 4, you get 8. Is that a possibility? What are other analysts on the street estimating on that number? So around 2 million simultaneously, expanding millions to new members, okay? So here's how much revenue increased by. So year over year, Q1 revenue growth of 41% to 180 million. And total visits, this is the accelerant factor. Total visits increased by 92%. So you can see how any change in consumer behavior, what's really happening on the ground, has an impact in the business. So if you have a company in your portfolio and you see that in the most recent quarter, revenue increased by 50 or 60%, try to pay attention to the main catalyst. What was the driving force that changed consumer behavior that caused people to use that product or service? And is that sustainable over the next 6, 12, or 24 months to come? If that's the case, then you might be looking at a company that can potentially grow in market share, become more profitable, and the stock price can also increase. So you have to be able to connect the dots here, and it's no different from Teladoc. And just here in underlying points that we've made, the increase in revenue includes an unprecedented surge in demand for our services in the month of March associated with the global outbreak of coronavirus. So the coronavirus has really impacted the overall economy. If you've been following these type of workshops and series that I've been doing on several stocks, you've noticed that Amazon on the tech side has benefited tremendously. You notice that Netflix also benefited tremendously. Zoom has been one of the clear winners during this whole pandemic. And now we're looking at Teladoc as well. So I just gave you 4 stocks that you can put in your watch list and see how the price of those stocks increase or decrease over the weeks and months to come. But more importantly, pay attention to the performance of the upcoming quarters. Are revenue increase? Are they expanding their number of memberships and subscription base? Because you have to know how they're monetizing it, and are they going to grow earnings per share, which is what I have a claim to and you have a claim to as well as an equity holder. So again, we already know what is the main driving factor, which has been the coronavirus. But is it sustainable? Once we are over the coronavirus in let's say a year or 2 years from now, we assume some sense of normality, a vaccine is introduced, can they continue to expand? That's the big question. Let's see here on another point. As our client and consumers have turned to us during these unprecedented times, our proven ability to meet their needs has elevated our global leadership role and accelerated our impact on the healthcare system overall. So it is obvious that they're starting to separate themselves from the competition, and this might be best of breed. This actually might be the best company to have exposure to if you believe that telehealth is something new, it's going to stay, and can probably disrupt the entire healthcare system, where hospitals, they have to lower costs because it's more cheaper to diagnose a patient through their application, just doing the diagnostics, right? Just diagnosing what they have. And it's cheaper than going to a doctor where you might spend, 3, 4, 5 times more than what Teladoc is charging you through their mobile application. And I believe it's around $45 or $50 is what they're charging for one visit just through this channel, right? Just basically through their mobile application. It's quite astounding how much they're able to reduce the cost of diagnosing someone just with their patient and then getting them the right care, whether it's a medicine, a subscription drug that they need. And if something more serious, they can partner them up with other doctors that they have in their system. It's quite amazing what they're doing. So in terms of financial performance, for Q1 2020, 76% and 24% of our revenue was derived from subscription access fees and visit fees. So subscription access are people that are already in their system, and the way they are monetizing it is that they first go to employers and they show the value of their product to employers and why it's probably better for employers to have their employees be part of the Teladoc healthcare system because it's cheaper. So from an employer side, you can see the benefit. It lowers the healthcare cost. The fee visits are people that are not part of their subscription service. So if you are a new one-time user, you might be charged a fee, and that fee could range between $40 or $50 depending on how long it is and what you need. And this visit accounted for 24%. This is the number that I'm actually looking at more closely. Can that 24% become 50%? Can it later become 80%? Why? Because again, like I said earlier, there's 7.5 billion people in the world. What if governments across the world adopt telehealth and all of their citizens as a first layer of diagnosing any symptoms that they have could be through telehealth? And it can serve to be so much more cheaper and cost effective than just going to a doctor and also overwhelming the healthcare system, like we actually seen and what was being expected in the US by several experts. We basically didn't have the necessary amount of hospital beds. I think one report that I looked at read that in the US there was, before pre-coronavirus pandemic, was about 655,000 hospital beds. And there was expected to be a surge of perhaps 2 million people in the US affected by the virus, and out of that 2 million, a certain percentage needed hospital beds. So they didn't have enough hospital beds. And then they had to do other things and get creative to increase that capacity. But can Teladoc be one of those alternative methods to diagnosing people just through video conferencing? And that's what's happening right now. So does it have legs? Time will tell. Then when you're looking at gross profit margin, this to me is a little bit concerning. Gross profit margin for the first quarter of 2020 was 60%, compared to 65.3% the year prior. Why did margin decrease by 5%, right? Is it increase in cost? Is it because they are adding more staff and services to their operation that is lowering their profitability temporarily? Because again, they have to increase their capacity to meet the surge in demand for their products, right? And obviously you saw here, 2 million new patients went through their system. So that's quite interesting. On an adjusted base EBITDA was 10.7 million. Cash flow, this is important. So they're not free cash flow positive. They're actually burning through a lot of capital. So the free cash flow for the first quarter of 2020 was minus 9.2 million compared to minus 9.5 million the prior year. So like I've mentioned before, they're spending a lot of money in their infrastructure, increasing their capacity to put them in a position to continue to scale and become the dominant global player in telehealth, in the telehealth industry. So this is okay. I expect this. But in the quarters to come and in the years to come, this better become positive. Because if it's not positive, then how is the company going to continue to expand? And when will they become profitable? When will they become free cash flow positive, right? Because they cannot continue to burn through money. How much longer can the market continue to, or investors can continue to lend them money and also buy their shares to give them more cash needed to expand? 5 years, 10 years? I wouldn't be the ones lending them money for 10 years if I think I'm not going to make a return on that money. So this is important to pay attention to, free cash flow. In terms of guidance, you can see here what management expect guidance to be in the range of 800 to 825 million. That's an increase between 45 and 49% year over year. When you're looking at total US paid membership of at least 50 million members, and visits free only access would be approximately 19 to 20 million. Okay, now do the math. What's the US population? 330 million. Right now, they're projecting to have in their distribution network 50 million. Can that number double in the next 2 or 3 years? Maybe. Can that number triple where they're addressing 50% of the population? The question is, okay, how effective is the management team to execute flawlessly to reach 50% penetration of the US population? And if so, how big would revenue be? Revenue would then at that level would probably be close to $2.5 or maybe $3 billion. What about the international market, which is much bigger than the US? So you can see here from a longer term perspective, there's a lot of potential in this company, but it really comes down to management and their ability to execute, and also competition. Who has a better product, or does Teladoc have the best product out there of anyone else? Okay, so very important to look at this. And then for the next upcoming quarter, this is what they're expecting. 8 to 9, no, for the whole year of 2020. 8 to 9, and then earnings per share loss. Yeah, they're still going to be losing money. $1.27 and $1.13 EPS on the downside. So don't expect earnings per share to be profitable, to be positive this year, because they're burning through cash. What you should pay close attention to is top line revenue growth, especially on any tech company that is growing fast. Early years, they're going to be burning through money, so it's going to be net income or EPS negative. Focus on sales and the growth of sales. So this is what I wanted to cover in their first quarter as highlight. Let's see here. The next slide comes more into analyst perspective. So we've looked at 3 research reports. One was from JP Morgan, then the other one was from Deutsche Bank and Credit Suisse. And you can see what the price target is on Teladoc, right? JP Morgan has $194 price target, Deutsche Bank $184, and Credit Suisse has $165. So let's look at these analyst reports a little bit more carefully and see what is the reason. What are they paying close attention to give them that price target? So JP Morgan, what's interesting, or what I found interesting, was this section right here. This is the cover page of their research report. So JP Morgan says, while we have previously highlighted a significant long-term opportunity, like we've discussed previously, around telehealth, we believe we are not now at an inflection point. So they still don't believe that this is going to, be widely accepted and hit mainstream where everyone adopts it, and then maybe they can go from 50 to 150 million people of the US population using their services. So they're not thinking that yet. With the pace of virtual care adaptation to accelerate as COVID-19 has driven increased awareness and led to new users who will likely be more willing to utilize telehealth for additional services growing forward. Okay, so they're basically, the way I interpret this is that COVID-19 has increased the level of awareness of what Teladoc has been doing. Some of those people will become paid subscribers. They'll continue to utilize their services. But it's not at that inflection point where now it becomes viral, where perhaps the government gets involved and they adapt this service and everyone uses Teladoc. I mean, think about that. If that happens, then this company will become a monopoly, really. If they get some sort of agreement with the federal government or with local state government where it can be cheaper. I mean, this is one way to cover healthcare costs if you really think about it. So I see their point from JP Morgan's side, but I'm not sure if they're also taking that into account. And also, has management giving any indication that they might be working with governments to lower their healthcare costs? So that could be a possibility. So JP Morgan, they're not believing that this is at an inflection point. It's not going to go viral as many other people believe yet. But we have to wait and see. And also, you can follow the company more closely and pay close attention to what the CEO and the senior executive officers of the team are doing to increase their coverage. That's very, very important. Let's look at the next analyst here from Deutsche Bank. So Deutsche Bank, what I found interesting also was right here, this bullet point over here. And remember, I was saying that the company was burning through cash, right? Their free cash flow is negative, and they're also losing money when you look at the P&L side, the income statement. Well, what does that mean? It means that they have to raise capital. They actually did a new raise of capital. I believe it was senior convertible notes. Here it is, almost $1 billion. $850 million they ended up raising. Now that $850 million, what are they going to do with that money? Well, they're going to invest it in their infrastructure. Deutsche Bank thinks that they're going to use some of that capital to be deployed in future M&A activity. This is quite interesting. So we suspect that Teladoc could use the funds for future M&A and continue to further consolidate the telemedicine space. Interesting. Teladoc also still needs to make the $150 million cash payment as part of their pending InTouch deal. Okay, so not only are they gaining new subscribers because of coronavirus, but in order to grow and increase their market share, they have to acquire other smaller players. So Deutsche Bank believes that the $850 million that they've raised, some of that will be used to make small acquisitions to increase and expand their business. Okay, and that's a strategy that a lot of companies actually do. They grow through acquisition. And they also have $150 million payment due. So now you can see where the $850 million is going to be used for. One, to pay down their mandatory $150 million of debt obligation that's coming due. Some of that will be used for M&A. Some of that will be used to improve their infrastructure, their technology, maybe hire more people, and strongly spend on advertising and marketing just to elevate the level of awareness. And these guys have a buy rating. You can see that right here. So they have a buy rating and a price target of 184. So that was an interesting point that I thought Deutsche Bank made, which I was not thinking that they will actually engage in M&A, given what they're doing right now with the coronavirus. But it makes sense. If they make the correct strategic acquisition, this can easily grow their number of members by 10, 50, 30, even 100 million. It's the strategic acquisition part that's important when you're looking at the company. So pay close attention to press releases by the business when they say we've made an acquisition on XYZ company. So very important. That is material information. Let's look at our next report, which is by Credit Suisse. And Credit Suisse has another similar point as well as JP Morgan. Look right here about this bullet point. Okay, so increased confidence in the 20 to 30% long-term revenue growth target. And when they're talking about long-term, they're talking about 5 years out. This is really good. 20 to 30% year-over-year revenue growth on the top line. It's something that not many companies are achieving. So this could be an indication that their business model is strong and more people will continue to adopt telehealth or telemedicine. So Teladoc notes that the recent uptick in consumer awareness of telehealth gives Teladoc increased confidence in its 20 to 30% long-term revenue growth target. Near term, Teladoc still expects the acquisition of InTouch. So this is an acquisition that made, I believe it was last year. Health to close near the end of second quarter of 2020 and will issue its updated guidance along with Q2. So Q2, it's going to be a very important catalyst because Q2 is going to give us more information if they're on track to meet 2020 full year guidance, 2020 number of paid members that they think they can achieve, and that can give us more guidance and a better estimate to project revenue for this year, next year, and the year after that to come. So Credit Suisse is getting confidence from the uptick due to the coronavirus. So this is what we're seeing here. And again, it's not a surprise. It makes sense. It's very easy. It's rational that with the coronavirus, people staying at home, the lockdown, if you need service, if you need a doctor, how are you going to get access to a doctor? Well, pick up your phone, download the Teladoc Health app, and type in your diagnosis, and then you instantaneously will be in touch with one of their healthcare providers, and then maybe with a specialist. So this is what's happening right now, and it's definitely a clear winner in the healthcare space. So the question again, it comes down to, can they continue to maintain this momentum? So with that being said, now we look at how do we value this business? Okay, so the first part is understanding the situation, the business model, how they perform in the most recent quarter, and what is the main catalyst? What is the condition, the business environment that changed consumer behavior? So we already know about that. Now it comes down to valuation. How can we value a company that is losing money? Remember I said focus on revenue growth? Well, look at these three analysts. And I've highlighted in red what methodology they're applying. So they're applying comparable company analysis, and they're using sales multiple, enterprise value over sales. You see here JP Morgan, this is their valuation. EV over sales multiple, and what is that multiple that they're applying? They're applying a 15 times multiple to revenue of 2021. Okay, and look at on a pro forma basis, 2021 revenue, they're expecting it to be 1.12 billion. Whereas company, by the end of this year, they're expecting revenue to be between 800 and 825. So there's still growth on this business. What about Deutsche Bank? Deutsche Bank, same methodology that they're applying. EV over sales, a 15 times multiple, but instead of 2021, they're applying it to 2020 sales. Okay, fair enough. Then if you look at Credit Suisse, same methodology. They're looking at EV over sales. You can see here, this is their gray sky scenario. EV over sales, 8-time multiple. This is more of their bear case. And then they have their blue sky scenario, where they're applying a 15 times EV over sales multiple to 2021 revenue. Okay, so how do we use this information to value telehealth and maybe apply our own reasonable multiple? Well, we first need to look at earnings expectations. And what I'm displaying right here on the screen is a combination of all the analysts that cover telehealth. Thomson One Financial provides this information where it's the average. So what you're seeing here for 2020, the average of all the analysts that cover this stock, they're expecting revenue to be 838 million, slightly above what management is forecasting. And that gives you a revenue growth for 2020 of 51.5%. Then the following year, 2021, 1 billion. And in terms of revenue growth, 24%, then the following year, 24%. So you can see that beyond 2020, which was heavily impacted by the coronavirus, it doubled the previous expected growth. Look at the next, look at beyond 2020, look at the growth, 20%, right? 24, and then 20%. If we did not have coronavirus, I suspect that 2020 would have probably more like 25%. Look at the impact to the business that the coronavirus has had to Teladoc. If we take 25% of 838, I mean that would give you probably an extra, maybe 150. We could say between 100 to 150 million of additional revenue went to Teladoc because of the coronavirus. Interesting. Look at the bottom line, earnings per share, down. When do they expect to be profitable on a net income basis? 2022. So if you're going to do valuation using PE multiple, this may not be perhaps the best methodology to apply or the correct metric to use. When you're dealing with high growth tech companies, use sales multiple. And the question now becomes, what is a reasonable multiple that to apply? As you saw, let me go back here. Look at the multiples that these analysts are applying. 15 times, Credit Suisse 15 times, and then their worst case scenario 8 times. So that gives you a benchmark of what might be a reasonable multiple applied by other Wall Street analysts. But what additional information, what difference of opinion do you have where you can justify a higher multiple? Because it's a growth company and they're probably the clear winner out of everyone else in the competition. So when you look at comps on this slide right here, look at all of the competitors. Okay, let's look at their margins. Let's see here. So the industry margin on average is between 54% and 57%, your mean and median. When you look at EBITDA, wow, this is very low. Okay, but of course, I mean, we're taking into account here some of these negative EBITDA margins. So if we would extrapolate these, right? If we would remove this, you're really looking at these companies that are profitable. And their EBITDA margin, if we were to take the average here, would be in the double digits, maybe 17, 20%. You can assume for this part. What about on the EBIT side? Same thing on the EBIT side, double digits. Okay? Okay. So Teladoc right now, they're losing money. But at least it gives you a benchmark of what's the potential from an EBITDA perspective or an EBIT perspective, where Teladoc could probably assume EBITDA margins of maybe 20%. Where am I getting that number? Well, look at the clear players that are profitable. Okay? What about multiples? Look at the multiples of some of these guys. On a sales basis, 5.6 times. On an EBITDA basis, 20 times. PE ratio, 36. Okay. Look at their Sales growth from 2020 to 2021, 7.1%. Look at these other guys right here with 20%, 27% EBITDA multiple. Okay, this company, look at their multiple. 6.1, 20, and 200. Wow, 200 PE. Okay. Look at the growth, 9.9%. Okay. Now Teladoc, they're losing money right now, but look at the growth of Teladoc in revenue, 24%. It's much faster than these other guys up here. So because Teladoc is growing revenue at 24%, not in 2020, we already know they're going to expect it to grow at least 50%. But the years beyond that, the next 3 years, is still over 20%. So do they deserve the same multiple as the industry? Do they deserve the same multiple as these other two companies that are profitable? The answer is maybe not. You might disagree. It's okay. Then you shouldn't buy the stock. But this multiple of 19.8%, that's the question. Is this reasonable? Is this a multiple that we can continue to apply to this company in the weeks and months and years to come? That's the question. So just looking at this, why don't we launch right now our poll? Do you believe you should buy or sell Teladoc stock, giving the revenue growth rate that you're seeing right here and giving how the industry is trading on a multiple standpoint? So let's launch that right now. Let me pull up our poll and we can launch it. Let's see, where can I find it? So you should see this on your screen. And there it is. So what do you think? Do you think they should be trading at that multiple? 19.8? Do you think it should come down? Or do you think it should be higher because of the level of growth? Knowing that they're not profitable today, but we can see that once they become profitable beyond 2022, they can potentially have EBITDA margins of 20%. What do you think? Okay. And 50% of you have casted your votes. Now 60%. So let's go. I mean, I want to make this more engaging, interactive. I want to get your participation. Cast your vote. Let's see if you guys would buy. And then we'll be able to illustrate it and share it on the screen. Okay, so 80% have already casted the votes. Okay, what about the other 20%? Are you guys sleeping? There you go. Okay, good. Okay, folks, yeah, so we got it to 95%. That's good enough. So I'm going to end the poll here, and I'm going to share the results, and you should see it now on your screen. And this is quite outstanding. 80% of you say buy. Wow, so you think it's a buy, but also they deserve a higher multiple. 20% of you say sell. Interesting. So now let's go ahead through the valuation process. Let's apply the technical skills and value the business on different multiple ranges. Let's see what that process looks like. Here we go. In the next slide, you see the price targets of the analysts, JP Morgan, Deutsche Bank, Credit Suisse, okay, and then the multiples. If we open up the actual spreadsheet, as I'm showing right here, let's scroll down, and let's go through this process. So when you're applying multiple valuation, there's different ways to go about this to understand it. So the first one, I'm gonna put right here, number one, is by using the industry mean and median, right? The industry mean and median number, in this case, the average 5.8 EV over sales. If we apply 5.8 multiple and calculate our enterprise value, which is sales times the multiple gives us enterprise value, we adjust for net debt, we get equity value, we divide the equity value by shares outstanding, we get an implied price target. Look at the price target. If we use the industry average multiple, 5.8, it's a share price that is well below the current stock price. The other one is to use the current multiple based on the current share price. Well, this right here has 21.1, but to be consistent with comps, let's change this to 19.8, like what I'm showing here on my screen. So let's link this to Teladoc current multiple of 19.8, and let's drag this across. Look at the share price. If we use a 19.8 multiple going forward for each of the following year, you get a share price of 223 for 2020. 2021, 276. 2022, you get 344, and then beyond that, you get 415. So is it reasonable to pay a 19.8 multiple? Can that stay consistent? The answer is no. Can the multiple increase? Of course it can. Can the multiple contract? Yes. The way I like to look at it is I like to pay for the growth of revenue. So you see here, row 45, the growth for 2020 on revenue is 52%. The growth for 2021, 24% and beyond that. I'm willing to pay, from a multiple standpoint, a portion of that growth. Look at row 64. And let's highlight it. And again, this is very technical now. 15 times. This is what other analysts were projecting, okay? If you use 15 times, you get 169 for this year. If you use 15 times for next year's revenue, you get 209. And beyond that, you can see obviously how it increases. See this table down here, the average multiple or the median multiple is 15 times. But should the stock have a higher multiple that's closer to their expected growth for the next 3 years, more in line with that 24%? Some of you might agree, others may not disagree. But I like to run and play with this and do this exercise where my premium would be equals, this would be the driver, and let's change this to percentages, right? So what would happen if I pay 50% of the growth? And of course, let's multiply this by 100 to turn it into a whole number. Drag across to the right. Look at the fluctuation in share price, right? What if you're saying, well, look, I'm not going to pay 50%. I think they demand a higher premium. I'm a growth investor. They are the clear dominant player. And the buy side, a lot of mutual funds, when they really understand what's happening, if it gets to that tipping point of inflection where Main Street begins to adopt this service, and perhaps other institutions, it could be universities, more companies, and even maybe governments might set deals or contracts on the side with Teladoc, which I'm not sure if with government, if the legality of that, but it might demand a higher premium. So you might say 60%. Look at the share price increase then. If you're paying 60% of that growth in form of a multiple. The multiple then for 2021 becomes 14.4 times, and that will give you a stock price of 201. That's up 25%. If you apply the same logic or process for 2022, the multiple becomes 14.6. And then if you multiply that multiple by revenue, you solve for your equity, you divide equity by shares outstanding, and you get your stock price. You get a stock price of 254. So it's not out of the equation or the picture, and it's not extreme or even illogical to think that the stock can be higher than what it is today. A $200 price target, it's not unreasonable. We can see that these multiples actually make sense, and it's in line with the median of 3 other analysts. JP Morgan, Deutsche Bank, they have 15. Credit Suisse, I mean, I'm using here their 8 times, but if we really look at their Blue Sky, which was their upside case, I believe the multiple was 14 times. Okay, and if we change this to 14 times, it's still 15. And I think this is reasonable. I think this multiple is reasonable. So if we had to come up with a price target just using this, I'm gonna get a little bit creative here. This is more art than science now. I'm looking at this multiple consistently. I'm paying 60% of the growth in the form of a multiple. I see my different price targets. I am going to take equals, give me the median of these ranges. And you get a price target of $243. A price target of $243, what does that mean from a multiple standpoint? We can take this and solve the equation, solve backwards. Here is my fully diluted shares. We can calculate our equity. Price target times the equity times shares outstanding gives us equity. We take into account our net debt. We add back the net debt to the enterprise value. Okay. This is subtracting it. Yep. It's changing the format. None. Enterprise value. And then what is the sales? Let's put sales up here. Actually, take the enterprise value and divide it by, let's say 2021 sales. What multiple do we get? We get a 17.5 multiple on a $243 price target. Now that might be at the higher end of the valuation range and maybe what other analysts are saying. Let's take a look at that. Let's take a look. What is the highest price target by some of the analysts on Wall Street? Look here at price target longer term, right? The mean and median is 174 to 180. Look at the highest price target, high, 220, okay? And there's 21 analysts covering Teladoc. So 220. If we go with our analysis and our price target, it's going to be above what the street is expecting. And you know what? The way I like to do my analysis and give my recommendations is with conviction. I'm either going to capitalize and make a substantial return and have conviction and believe in my own analysis. However, making sure that I understand the downside risk and I limit my potential losses. So with that, let's look at the graph and apply technical analysis and see how the stock chart, what information it tells us about the stock. And is there harmony between the price target that I see right here, okay, that I come up with 243 and the stock. So let's look at that. Here we go. Okay, so this is Teladoc, and you can see here from January 2020, stock being at $86 and now currently being at $161. So the first thing I want to do is apply technical analysis. Let's look at the bigger picture, zoom out, look at the monthly. Okay, notice that there's a pattern here. You may not see it, but to the untrained eye, you're not going to recognize it. So it takes time to understand these patterns. Here's what I mean. Nothing goes straight up and straight down. Here is the first move to the upside. Here's the correction, breaks resistance, and it gives you another wave higher. Now we've already established points of inflection up here. This would be my resistance. Is this the pullback that most investors are waiting for in anticipation to another move to the upside? Perhaps. So let's draw this here with our actual vertical lines, horizontal lines right here. This is my point of resistance where we can draw my uptrend. Let's go to the weekly, but here, let me draw this one over here. Now let's change it from monthly to weekly. Here it is, okay. Let's draw my uptrend line because this is still in an uptrend. I can see it right there. Okay, we could do one here. And then there's a shorter term one, which is, we can do this. Okay. And again, folks, this is more art than science. And we even have support over here at this inflection point. Let's draw that. Wow, it's right there. Now we look at the daily, and it should be a little bit more clear. Okay, there it is. Wow, it's actually bouncing from 150. So there's a buyer at 150. You're seeing it here. Look. So yesterday on Friday, it tagged that inflection point or point of support. You can see it here. So is this the floor in anticipation for another move to the upside, right? Like what? It did it over here. Look at that. It went up, came down, and it moved higher. It did it over here after it broke out to all-time highs. It went up, came down, and then it continued its trajectory to the upside. So now we have to anticipate this. Is this what's happening? So my course of action, my suggested execution plan for this stock would be to start buying it right around this area and have a stop loss because we have to limit our downside. My stop loss will probably be at the low of this day, which was Friday. The low is 149. Yeah, I would definitely buy the stock in between this range right here. Let me clear this up. There we go. I would buy it between this range here and here, okay? But if I buy it here at 165, I always give a 5-point stop loss. Sometimes if I really believe in the stock, I'll give it a 10-point stock loss. So if I buy, let's say at 161 or 165, no, what was the close? The close was 161.65. So my stop loss will probably be 155 or the low of the day. And if it stops me out, non-negotiable, I'm out. And in terms of portfolio allocation, I will probably put 20% of my portfolio in this one idea, okay? And if it works out, we can see the potential from the chart. Let's go back to the weekly. What is the potential? What is the most clear move that we can look at? We can see from this low to this high to this low swing point. And stocks always move in waves, as I like to look at it. I recognize the pattern. So that first wave should equal to the second wave. So the second wave, if that's the low, we should continue over here. Let's minimize this. How can we minimize this point? There we go. So on a graph or chart basis, let me remove this. For some reason, my mouse is acting up here. So my projected move could be, wow, look at that. 253. 253. Okay, let's put that here. Projected price target on technical analysis. Price target 253. Okay, let's go back to the daily. This is where it can potentially go based on the technicals, based on what I just looked at. 253. If again, provided that this is the low, the fundamentals are strong, and in the second quarter they beat expectations, this can definitely come up to 253. And we did this analysis before on Zoom. If you haven't seen that lecture, go back and watch Zoom. The same scenario played out perfectly with Zoom, exactly like this. Here, let me pull it up. Here's Zoom, right? Well, this is the one I'm looking at right now, waiting. But when we did Zoom, we were looking at it over here, and we said, look, if it comes down here, this will be the opportunity to buy. And then we had around, I believe it was like a $200 price target. They reported better than expected earnings, and the stock just continued higher to 222, give or take. You see here, goes up, comes down, goes up, comes down, goes up, comes down, then goes up again. That's the same setup that I'm seeing right here from the chart that is happening on Teladoc. And we have the fundamentals now to support higher price target. Let's pull up again the spreadsheet. 243. And if you don't think that 243 is the right price, then that's okay. Change this. Maybe you should say, look, I'm not going to pay 60% of the growth in the form of a multiple. Change that to 55. You still get 233. Okay? It's reasonable, right? 16.7 times. It's not that. I think for a growth stock that can potentially be the clear winner and increase their membership, I think 16 multiple is reasonable, right? Some companies are trading at 25 times EV over sales, even 30 times EV over sale. I mean, take a look at Zoom. They're trading much higher than these guys. So I think it can happen. Okay, it can happen, but always rest assured that you limit your downside, because not every investment thesis is going to work out, right? Some of the best investors out there, they're only right 50% of the time. And this is how we can have an analysis before we place a bet on our analysis and investment thesis and then put it in the portfolio. All right? So I think this is quite interesting. So let's go back to the presentation and look at this. So this, what I'm showing right here, this was the investment thesis put together by one of our analysts in our program, one of our interns. He has a $123 price target on the stock. So he had a sell rating. He just thinks it's too expensive. He thinks it's overvalued. But that's okay. That's his opinion, right? You have other analysts that think the stock is also expensive. So that's what makes the market. but you have to do your own homework. You have to understand the process of performing due diligence to assess the situation overview. Apply your technical skills to come up with a understanding if the stock is overvalued or undervalued, and then with step 3, your investment thesis, what's your price target? What are the reasons for you to support going long or short the stock? And finally, here's what to pay attention to. How do you put everything together? Well, first assess the first quarter and then look at their platform. All right? From the first quarter, we already know their strong application, it's working because of the increase in visits, 2 million. We already know this is a growth story. Revenue increased 41% in the first quarter. We already know that Teladoc is helping solve 2 key important factors in the US, which is high healthcare costs and lack of access. So it's a very important solution to a big problem, not only in the US, but also outside of the US. Upcoming catalyst is Q2 earnings. Pay close attention to the number of paid membership numbers and also free cash flow. Can they improve their free cash flow numbers? And lastly, to help you perform due diligence, when you go to the company's website, right, here's Teladoc landing page. Go to under About, under Footer, see where it says Investors. Let's click on this and look at the press releases. View all. No, this is events. Let's go back. News and event. Let's go to press releases. Okay. See here the bond offering of 250 million that I believe it was the analyst at Deutsche Bank talked about. Read this and see how they're going to use those proceeds. Teladoc announces proposed offering, new study, COVID-19. You may want to read this, but this first quarter, you should read it and pay close attention to the comments that the CEO of the company is saying and look at these numbers. The other thing that would really accelerate your understanding of the business is in a section, it's going to a section known as events and presentation, this one. If you scroll down, you see here Teladoc Health 2020 Investors Day. This is their presentation to all investors, not only just retail investor, but it's actually more for institutional investors, hedge funds, pension fund managers, mutual fund managers as well. See here presentation, you click on that and you're gonna get a lot of in-depth analysis and on the overall business, which was put together by the CEO and other senior management of the business, right? So over here, they tell you their investment highlight. They tell you what are their values. They also go into their global channel, their execution strategy. I mean, this is amazing. Like they're giving you everything you need to know about the business. Every publicly traded company has an investor presentation section on their website, and some of them will have the presentation, not all. But Teladoc management did a really good job with this presentation. It is very detailed. I think this is one of the best management presentations I've seen. So I just wanted to show you where to find that information, how to access it, and put in the right amount of time in going through this because this is very detailed. And they're telling you what their strategy is. And who knows, maybe they might outperform all these numbers, right? And maybe revenue won't be 21% in 2023. Maybe revenue will be 30%. Maybe they might be surprising to the upside. And surprise these analysts. Surprise JP Morgan, Deutsche Bank, and Credit Suisse. And if these guys are surprised, what do you think the stock price is going to do? It's going to go higher. It's going to exceed their expectations. And maybe we might be in a scenario where the stock is trading at 230 or maybe 240. Okay? That's just one investment thesis. That's my observation. You could disagree with it. It's okay, but do your own homework and then place your bets. That's it. That's what the market is really here to do. It's a collection of different opinions, different analysis, and you have to put your money where your mouth is. So on our end, this is how I'm looking at it. If the stock comes, actually, yeah, I think I will have to look at my portfolio and see, but I'm definitely paying close attention to this. On Monday, I might be looking to buy this stock. I'm gonna play it differently though. I'm gonna play it on the option side, and my target will probably 253. And I'm gonna take maybe 3 to 6 months expiration period on how I may execute this. because it's right there. It's right at the inflection point of where we should be buying it. And again, the same thing occurred with Zoom down here. And it did it prior to that in May, it did it in April, and it did it in March. So you could see that this patterns repeat itself, and when you combine it with the fundamentals, the probability of you being correct increases. It's all about putting the odds on your favor, all right? So with that being said, I see a few questions here. So I'm gonna address some of the questions here. So Nicholas, it says we are now at an inflection point. Nicholas, yes. Let's go back to Teladoc. Yes. Why do I say it's at an inflection point? Well, here, right here. This was earnings on March. This was actually February 27th. This one right here. Look at the volume. Okay. So this area is acting as support. That's what I'm seeing right here. Every time it gets to 248, you get people to bid the price higher. Let's put this back. So this is why I'm saying that. And you can see it shorter term. I mean, last week, every time here it hits this area, twice the stock bounced from that. So that's why I'm saying this is an inflection point. As a trader, as a technician, and looking at charts, I pay very close attention to that because there's someone buying at this area right here. And that's around what price this is. This is give or take 147, 150. There is a buyer. So it takes millions of dollars to move this stock. So I probably want to be playing this the way they are bidding it up. And I have the fundamentals also that can support a higher price target. Does that make sense, Nicholas? Yeah? Okay, good, good. Any other questions? No? All right, folks, if there's no any other questions, we'll be posting this up in our YouTube channel. Again, don't forget to subscribe. I hope you found value in this, but pay close attention to the process so that you can apply it to your own stock analysis, your own portfolio, and that improves your skill set in becoming a better analyst and ultimately a better investor. So with that being said, I'll end the session here and I'll see you in the next one. Take care.